Ever wonder how a single deadline set by a world leader can put the entire global financial system on a collision course? Well, that's what we're breaking down today. We're looking at how one escalating conflict and a ticking clock are pushing the world's economy right to the edge. Okay, let's get into it.
It all kicks off with words like these: a direct, unambiguous threat from the U.S. president. Now, this isn't just political posturing. This is a promise to obliterate critical infrastructure, and more importantly, it sets a hard deadline. And that forces everyone, especially global markets, to stop and pay very close attention. The tone is set, and believe me, it is tense.
And what this does is it creates what analysts call a binary situation. Basically, one of two things is going to happen. There's a deal, or there's a massive escalation. There's really no middle ground. So the entire global economy is just holding its breath, waiting to see how this coin flip lands.
So let's track that first ripple effect, the immediate knee-jerk reaction from financial markets all over the world.
Right, so when you're faced with this kind of raw uncertainty, where does the money go? Where does it hide? The initial data paints a really clear picture.
First up, and no surprise here, oil. The price of Brent crude, which is the global benchmark, shot up to $111 a barrel. This is the market's most direct way of saying, hey, we're pricing in a huge risk of supply getting cut off in the Middle East.
At the same time, we saw the yield on 10-year U.S. Treasury bonds jump to 3.4%. Now, why does this matter to you? Well, because rising oil prices usually mean higher inflation is coming. And if you're holding long-term bonds, inflation is your worst enemy. It just eats away at your future returns. So investors start selling, and that pushes these yields higher. It's a huge warning sign from the bond market.
And what about stocks? You guessed it, U.S. stock futures immediately went negative. This is classic risk-off behavior. Investors are hitting the brakes on equities because they're worried about what a wider conflict could do to corporate profits and the whole S&P 500. So if you look across the board here, what you're seeing is that classic flight to safety. Investors are dumping riskier assets like stocks and even some bonds, and they're running to the perceived safety of cash and the U.S. dollar. The dollar is still seen as the world's safe haven in a crisis. As one risk strategist said, there's a mountain of cash sitting on the sidelines right now, just waiting to see if it's time to brace for impact or buy the dip.
So why such an extreme reaction from the markets? It all comes down to one tiny, critical piece of geography, the Strait of Hormuz. You have to think of it as the main artery for the entire global energy market. Just take a look at this number, 20%. Let that sink in for a second. What does that actually represent? It means that a fifth of the entire world's oil and gas supply funnels through this one narrow channel. With that strait effectively shut down, a massive chunk of the world's energy is now stuck in the middle of a conflict zone.
And as you can see here, a simple solution is, well, it's nowhere in sight. The U.S. is demanding the strait be reopened, no conditions. Iran is firing back, demanding a permanent end to the war and, get this, a $2 million toll for every single ship that wants to pass. These two sides aren't just far apart, they're on different planets.
This deadlock has basically forced the rest of the world to step in. You've got major nations from Europe, Asia, and the Gulf all scrambling to form a maritime coalition. And their goal isn't just about military patrols, it's economic. They have to figure out how to protect global trade, how to deal with shipping insurance premiums that are going through the roof, and somehow reopen this vital artery.
All right, so let's follow the thread. We're going from high-stakes geopolitics right down to the real-world impact on businesses, supply chains, and ultimately us.
This quote just perfectly captures the brutal economic reality of the situation. It's not just a supply problem, it's a massive price shock. Think about it. If you're a European manufacturer and you're suddenly paying 5 or 6 times more for energy than your American competitors, that's not just a disadvantage, that is an existential threat to your business.
And you can literally watch the dominoes fall. It starts with those higher energy and shipping costs. That leads to major supply chain disruptions. Those disruptions crush your profit margins. And the final domino, companies are forced to go to their investors and say, yeah, about those future profits we promised, they're not going to be that high. And that forces them to rethink everything, including long-term spending plans. Which means, for investors, this upcoming earnings season isn't really about what happened last quarter, it's all about the future. Everyone is going to be glued to the management commentary, listening for one thing and one thing only. What is your plan? How are you going to build a more resilient supply chain? How are you rerouting ships or absorbing these insane fuel costs? That's the billion-dollar question.
Okay, let's zoom all the way out now for the final and frankly, the biggest ripple, the threat this whole thing poses to the entire global economy.
The word that's making everyone nervous is stagflation. It's a scary throwback to the 1970s oil crisis. And it's pretty much the worst of both worlds for an economy. Prices are skyrocketing, but the economy itself is grinding to a halt. It is a toxic combination that is incredibly hard for anyone to fix.
And look, this isn't some abstract theory. It's already happening. Germany, which is Europe's biggest economy, has already had its 2026 growth forecast slashed significantly. So the stagnation part of stagflation is already here.
This whole situation puts central banks in a totally impossible position. See, this is what's called cost-push inflation. It's not happening because the economy is booming. It's happening because of a sudden supply shock, like an energy crisis. And as you can see, they have no good moves. If they raise interest rates to fight inflation, they could completely kill off what little economic growth is left. But if they cut rates to try and help growth, they risk letting inflation spiral out of control. They're trapped.
Which brings us to the final and most critical question of all. With prices going up and growth going down, are our central banks fresh out of good ideas? This isn't a problem that their usual tools were designed to solve. As these geopolitical deadlines create very real economic pain, you have to wonder if the markets are truly pricing in this threat, and what tools, if any, are even left in the toolbox.